Andrea. She said, we emailed each other this week. I was asking about selling in the money call options. And I linked her to a webinar where we compare the different strikes that one might consider. What is the best strike price for a covered call? In the money, at the money, and out of the money? Well, it depends on your outlook. It depends on your goals. Ernie's testing showed that the in-the-money covered calls worked best over time in various market conditions for the protection, not being married to the stock itself as we are to the married put position, but just looking to generate income. Andrea says, I usually sell out of the money options in the covered call strategy. Do you think we could look at this subject again tonight? It's 10:30 in Italy, so it's probably a little bit later now, so she'd like to get into it. Again, as I mentioned, the webinar I discussed, let's go over here, and I'm just going to use our search function. Actually, let's just go to the playlists. And the various playlists we talked about, bull call debits, volatility in the stock market, buying calls, bear put debit spreads, so on and so forth, calendar calls, covered calls. Let's view the full playlist. Now, here's just a quick 1 minute and 33 little promotional intro video that says what is the best covered call strike price. And here's one on calculating the best strike price for a covered call based on your expectations using one of the tools that we have on PowerOptions. But why use an in-the-money covered call? It's better downside protection, better probability of being assigned, and earning the return, as opposed to speculating. Selling an in-the-money covered call, at the money covered call, and out of the money covered call, are all good income generating strategies. Why would you choose one over the other? Although I mentioned to you, Andrea, what's discussed here in these webinars that you watch, why would I use an in-the-money covered call? Why did Ernie's testing for the monthly picks of the day and the weekly picks of the day pull up calls that are in the money? Because in this approach, with buying stock, selling an in-the-money covered call with a high potential probability of assigned, we're not married to the stock, we're not looking to hold it long term, and we're not quote-unquote gambling on speculating that there's going to be a run up where I could see a 10, 15, or 20% return while still generating a little bit. Andrea, if you have a stock that you like, that you want to hold long-term in your position, long-term in your portfolio, I should say, which was mentioned in that video, then yes, you'd want to sell out of the money covered calls. You don't want to be assigned. You want to keep the stock long-term and keep generating income. That is the approach when you use out of the money covered calls. But if you want to earn consistent income in various markets while having a decent hedge against your position with this covered call approach, which does leave the downside open, it's not as protected as a married put approach, then you'd want to be looking at in the money covered calls. I'm not looking to hold the position long term. I'm looking to use this strategy to get into covered calls, get assigned, make my 1 to 2% per week, 0.8 to 1%, I should say, per week, or maybe 3, 4, 5% per month with a 60, 70, 75% probability of getting assigned and earning that return while having a good downside protection in place. Let's go back to Rambus right now. We're going to go back to the Rambus chain. I'm sorry. That was our custom spread tool. Did I have it still? Yeah, there it is. I see it. Back to the Rambus chain, but we're going to go to the current position. Okay. And we're going to look at July. Let's look at June, 14 days out, Andrea. Again, we already saw the stock chart, and based on this movement, you could say, hey, this stock I think is a good runner. I don't think it's tapped out yet. Yeah, the MACD is showing me that it's slowing down a little bit. But your analysis is, I don't think this is slowing down. I think this sector and this industry with the tech and what they're doing with security for Rambus is a good thing. I think this stock could actually hit 90 or so in the next 3 or 4 months. That is not a recommendation or suggestion. That is not a projection of mine. We're just doing hypotheticals. So I want to take advantage of this. What am I likely going to do right now with Rambus trading at 63.86? Well, I might buy the shares of stock, and here on the call chain, we show you all of the pertinent returns that you'd want to see for a covered call position. And you can actually customize this if you wanted to add annuals. But what are the important things when I'm considering when selling a covered call. The downside protection, simply the option premium I'm collecting divided by the stock price. In other words, how far percentage-wise can the stock drop before I'm technically losing money on the position? The percent if assigned. Hey, if I let the stock go above my strike price and I get assigned in the next 14 days, what is a good target return I'm looking for my goals? And what best suits that? Percent if unchanged is very similar. I actually don't have that here. And the probability. I'm going to hold this position long term. I want less than maybe a 30 or 40% probability the stock will be trading above my strike price. Naturally, I'm targeting out of the money, as we talked about, Andrea. But if I want a higher potential of being assigned, earning this return because I'm not married to Rambus, I just like the premium and like the recent run, I'm hoping to be assigned, be out of this position, and in 14 days make 1.3% with a 77% probability, also a 7.3% downside protection. I'm going slightly in the money to the 60 strike call. That's what I was trying to impress upon you in the video. Based on your outlook, based on your goals and what you want to do, there's no one wrong way to trade this. Well, we're looking at 14 days out in time, buying the stock at 63.86. Hey, I could sell the 55 call for 9.10 at midpoint. We're just going to use midpoint prices here, Andrea. This gives me a 14.3% downside protection. The stock can fall 14% or $9.10 before I start losing money on the position. I'd consider this an overly conservative hedge. It's a very high downside protection. What do I mean by conservative? Well, relatively high protection, 96% probability the stock will remain above my strike price, but what am I giving up? Return. 0.4% in 14 days. Might not match your trading goals. And this is also on the assumption that I'm looking to be assigned and just have that good probability of earning this return after Rambus is assigned, if it works out the way I want to, and I'm out of the position on June 16th, I'm just going to run the PowerOptions search again on June 19th, the following Monday, see what positions match my criteria with the high probability of being assigned. Likely in this case, honestly, I'm not married to this position. I'm not planning on it to be long term. If my expectation, Andrea, was that the stock might hit 90 in the next few months, yes, I'm probably buying at 63.86. And I'm probably selling even potentially the 70 strike for only 50 cents. That's going to drop my cost basis down, but it only gives me a 0.8% downside protection. My hedge is only 0.8% of the price I paid. If the stock shoots above 70 in the next 14 days, I might make 10.5%. But the percent if unchanged is the same as a downside protection. Stock stays around the same price, just moves up, it expires. I've made 0.8% in 14 days. There's only a 13.8% chance. The real concept here, Andrea, and of course, yeah, the 65, sorry. Dominic mentioned, well, the 65 strike looks more appealing. And it might be more appealing based on what you're looking for. Right at the money, 170 midpoint, 2.7% downside protection, remember, for 14 days. Stock can fall 2.7% or $1.70 in the next 14 days before you start losing money. If the stock is above 65, continues this run, we make 4.6% in 14 days. I'm sure that would meet most of our goals for the covered call strategy. There is only a 41.7% chance the stock is going to be trading above $65 per share, and we'll make that 4.6%. It's not for me to say that either one of these is right or wrong. What Ernie developed with the monthly picks of the day and the weekly picks of the day, Andrea, and why you see them in the money is because we're not married to the stocks long term. We're looking for good positions that are in a good trend that match the stock criteria. 80 iterations he tested of essentially stock criteria and option criteria in different market conditions to see which return worked out the best. And it's typically the in the money call because we're not married to it. Andrea, if I'm married to a position, and when I say married, you can tell where I'm going, but if I expect Rambus to continue this run, and I expect in the next few months or so this is going to be at $50 per share, and I want to take advantage of that upward movement, I am not using a covered call strategy at all. something that leaves the downside open, essentially minus the hedge I collected, same as owning the stock, but caps my gain. If my expectation is Rambus might hit 70, 72, or 73 in the next 4 or 5 months, I'm using what we just showed in the first part of this presentation. I'm opening this as a married put position. I'm still going to sell premium against it, following the rules in the blueprint, using just income method number 1. So, is the idea for your portfolio, Andrea, to use covered calls on stocks that you want to hold long term, generate a small income against that premium, acting as a dividend-like payment week by week, every 2 weeks, or month by month, then yes, you want to be using out-of-the-money covered calls. If your goal is to generate consistent income, and these 3 topics go naturally into our next 3 questions, and you want to use the covered call strategy, which does have its flaws, by the way. We all know that. But if you're looking to generate consistent income on a good weekly, 2-week, or monthly basis, you're likely going slightly in the money for the higher probability, and you're not considering holding Rambus long term. You're looking for the trade that matches the stock criteria, that matches the sentiment for the strategy, having a good probability of being assigned, earning that reasonable return for 7, 14, 20 days out in time, and still having a good downside protection in place in case you're wrong about the position or something unexpected happens in the market. But as we all know, the covered call strategy by itself is flawed in the sense that you're generating a premium even if you're going in the money. For example, I don't want to do it that way, but even if you're going in the money, the covered call structure by itself leaves the downside open as much as just buying the stock, minus the premium you collect on the trade. There's still a downslope there, still a big downslope. What do we always talk about with the married puts? Well, if I'm bullish on a stock longer term that I want to hold, what I want to do is cut my losers short and let my winners run. Oh, sorry, that's not what I meant to do, folks. That's exactly what the basic tenet of the married put does. For the covered call, we're cutting our winners short, even going out of the money. And we leave ourselves open to allow the losers to run, where now we have to aggressively manage the position, and it might take us several months to get back to break even just selling calls against it. That's what I was trying to press upon you with the videos, Andrea. That's what I was trying to show with the discussion. There's nothing wrong with selling an out-of-the-money call if you're holding the position long-term. You don't plan on selling it. You don't plan on being assigned in those cases, and you're looking to collect a dividend income on a regular basis. However, if you're more bullish on a stock long-term, you're expecting good movement and good growth, the married put approach, leaving the upside open with the ability to generate income in the shorter term, I think is a better play. The in-the-money covered call position is more of a strategy just like you'd use with bull put credits. If I'm holding Apple in my account, I'm not consistently selling bull put credit spreads against it, right? I mean, I could. There's nothing wrong with doing that. That is an approach that some use. But when I'm doing a bull put credit spread, it's with a smaller portion of my portfolio. We're looking for good premium that have a good probability of expiring worthless. It might be different stocks each cycle because I'm looking more at the structure of the trade, the criteria, and the goals of my portfolio in those positions. Okay? So Andrea says, okay, clear, thank you. Well, I'm glad that's clear, Andrea, because I felt like I talked in circles a couple times on that discussion. And I apologize for that. But there's nothing wrong with that. And that's what those videos did try to eventually discuss, is the fact that why use in the money covered calls? Hey, we talk about why we show them, why one would use them. But there's nothing wrong with using an at the money or out of the money covered call. It depends on your risk tolerance. Depends on your goals for the strategy in your portfolio, what you're looking to achieve in your portfolio going forward. And again, for those of you that are just joining us today and have come into this conversation, take a look at that playlist on our YouTube channel, calculating the best strike price for a covered call, why use in the money covered calls. Similar discussion, but just different examples illustrating, hey, it's okay to use those structures with the covered call strategy based on what kind of stocks you want to use, why you're holding the stock in your portfolio as well. Now, I mentioned in this discussion that one way that out-of-the-money covered calls are used, of course, is to generate a dividend-like income on a weekly, 2-weekly, or monthly basis against a stock position you're planning on holding long-term. An extra little oomph, income generation in your trade.